Hello, it is the 10th of December 2010. This is the quarterly open, high, low, close candle chart. What that means on a green candle is you have the open, the close, anything above here. This is the high, and this would be the low. Those are the basics towards the candle. Because when you look at one, you could see, for example, in this one here, it obviously came up to this point and it came back down a little bit, and that's usually no big deal. That's very common within the market. We'll go over different entry points, different exit points, and when you use a chart like this, you could say, you know what, I don't really want to play the paper market. I don't want to be a day trader because it's just a lot of time, an effort I don't want to get into, and that's understandable. And in a situation like this, you look at the charts every so often, and that's because these don't complete its candle until 3 months or only four per year. And if this was an intraday chart, say the Dow Jones, this could be a 200-point move up and down. If you're playing this and it's getting close to the end of the day, you'd be seeing this break and thinking, you know what, I can go long, and it's going to go up to this, probably up to this point, maybe come up to here, pull back lower somewhere, and then break it by the end of the day, and that's it. That's how it might work. And if that's the case, we'd be talking silver 130, 160 because of the amount that or how rare that these move towards. And if this was 2 seconds, then there's about 20, 30 seconds left before this ends, and you probably think, okay, this does look like it's a rally for real. We've got a nice candle here, and this is pretty much a confirmation that it's at least going to end up finding support here and end up moving higher. And we've had a small pullback and something like this now. There we are, a little pullback, not that big of one, but enough where we could say in here, well, wasn't that big of a pullback in there. So what we'll do is we'll now go through the market from the start to the end and just analyze a bunch of different things. You had a move higher, consolidation, move lower, sideways range, and it broke down here. That was an opportunity to short the market. When you had a break below here, you could short it. Now you waited for confirmation, didn't get much in here, and if you use fundamentals, you're shorting at $1.50. Really? Okay. At that point, with what was going on in 1968, the mathematics would have said no, you don't short. But in here, you have a nice confirmation, which this downtrend line, however you draw it, this is not a straight line, but that would have been broken, no matter how you draw it, of course. And after you break this, look at the moves that come to the upside. So when people say, oh, charts look like they're up too much, well, we'll get into that up towards here, but there really wasn't much of a pullback. Now, there was a consolidation, so there's your pullback right here. So if you wanted to get into silver at this point here, and you didn't do it because you never had a price correction low enough, then you had your opportunity in here. And if you follow the candles again on the breakout of the range, notice how the movements in here are showing higher lows. Therefore, you have a confirmation candle here, and boom, the big moves. When you have the parabolic moves, at some point, if you're buying at 7, if you're buying at 5, if you're buying at 12, and it's getting up to 40, 50, you're going to take some off the table. If you were buying on these moves higher, the majority should have been sold within here. If you're buying at this breakout point at 8, 9, and it gets up to 30, 40, if you haven't taken any off the table, I don't know what to say. And when you get the big move, something has to follow, because people are saying sometimes silver's up too much. Well, look at these levels here. This is $10, this line. 10 to 50, that's a gain of 400%. That's pretty big. And the same thing is going to possibly, well, it shouldn't be possible, but looks to be happening on these breakouts, because this candle is looking pretty much familiar with this. That's what's looking very close in the comparison feature. But after the big moves, you notice you have a big candle. When any time frame has a big move like that, it needs to settle down. And it settled down with the big move lower, managed to hit this bottom, came up top, and it established its range. Notice the breakout below. There's the time frame where there was a red alert. It might be time to even do a little bit of shorting, and the market had its final push lower, at least for a decent amount of time frame, that is. Markets move towards this choppy range in here, and these ones are the ones that are the most difficult to trade when you are moving sideways. And when that's the case, a lot of times you can just adjust to some shorter term time frames. And the same thing is true when you're in these big candles. If you're in a larger candle, then you might want to switch from quarterly to a weekly or a monthly chart. Even then, if it's really crowded, you go to a daily chart, and so on. So if you're trading this on a 2-minute time frame, you would want to see what the tick by tick is if you want to make your decisions on any long purchases, because there's no pullbacks on these types of moves. Now on the breakout towards that we've been receiving, the uptrend line was established in towards here. Every one of these past ones obviously had failed, and this ended up being a massive breakout candle with nice confirmation. So at this point, you're like, yeah, it's time to be going long here. Silver at 12 or something in that area. And the entire pattern here is telling us that it's obviously an upward trend, but it's got the up and down movements consolidating back and forth, and thus keeping its energy for the higher gains. Now the movement in 08 that brought the market lower gave us a point to find resistance at the big support level of 11. And it dipped below it, which thus created a bear trap. A bear trap is when the market looks like it's headed for a doom, if you will, and in a heartbeat it reverses itself, and then usually you get a major move. And that was when it ended up breaking below this key level of support, which was resistance on a couple of occasions. This was the failed move, breaking below 10, and since then it's been nothing but fast moves towards the upside. So now we look at this candle formation, and you can see here you have a higher low, higher low, higher low. You're continuously getting higher highs and higher lows. And this here is confirming, yep, if we're making that type of pattern, we may need to consolidate somewhere, either through time, through price, and if anything was a consolidation upwards. That's pretty bullish, which followed with this green candle breaking the resistance, and now we have confirmation. We can still get that pullback now, either through sideways action, either something like we have in here, maybe we range in an area like that, or of course it can be down towards this what ends up being around a 21, 22 level for the long term, and at the same point the rally can still continue going further. There's no need for the pullback in here, because just because the market looks like it's up too much, like it did back in 1979 when it was $10 an ounce, it doesn't mean it cannot go higher. Thank you for watching.